Hi everyone and welcome to our channel. I'm Sudhir Mulchandani. Today we have a special guest, Aashish Sommaiyaa, the CEO of WhiteOak Capital AMC. Welcome Ashish.
Hi, Sudhir. Thanks for having me here.
Anytime Ashish. So Ashish, we'll talk about the NFO of WhiteOak Capital Balanced Hybrid Fund today. Can you explain our viewers the investment philosophy behind WhiteOak Capital Balanced Hybrid Fund?
Sure. No, Sudhir, so, thanks for doing this. I think, you'll be surprised to know, or our listeners might be surprised to know that, the private sector mutual fund industry has been around now for exactly 30 years. And at this late stage of evolution, we are out here discussing a balanced fund. I mean, what is so great about a balanced fund, right? Typically, it's the most standard or the most simplest of products. But why I said you and our listeners will be surprised is because the reality is that there is practically no balance fund in the industry. And a lot of fund structures and a lot of investments that our investors make is so much driven by the penchant for avoiding taxes, right? So you must be aware that in our industry or in our tax code, a fund which has more than 65% in equity is classified as an equity fund. And equity funds, obviously they at the end of 1 year, an equity fund becomes a long-term asset. And then, if it's a long-term asset, there is 10% plus surcharge, that type of taxation.
Correct.
So as a result of this, in originally 30 years back, maybe there were balanced funds, but since the time the taxation has been this way, balanced funds, started keeping 70% equity and 30% fixed income. So in that sense, you can say balanced funds had always had a very heavy imbalance, actually speaking,
More aggressive
very
towards
aggressive.
equities.
Yeah. And by the by, I must tell you that all the good theory of finance, whether it is written by a Nobel Prize winner like Harry Markowitz, or it is written by a guru like Benjamin Graham, there's enough literature you will find which says that if you have two asset classes, then 1/n, meaning 50-50, half and half is the best asset allocation you can make. If you have three asset classes, then one third, one third, one third is the best allocation you can make, and then you keep rebalancing it. So the theory of finance and all the good practices actually demand that if you want to make a all-in-one product, then it should be 50-50, right? But here there's so much penchant with covering taxation that we moved a balance fund into 70% equity, and so much so that in 2018 the regulator had to step in and say, sorry, you cannot call this a balance fund; it will be called an aggressive hybrid fund.
Right.
So here we are, now we've finally created a balanced fund which is fully balanced because it will on an average have 50% equity, 50% debt. If any of the asset classes hits a upper bound of 60, it will be brought back to 50. And any asset class hits a lower bound of 40, it will again be brought back to 50. So our experience, we've done all the data and, all the back tests that, why do some of these gurus say that 50-50 is ideal? And you'll actually find, if you see some of our literature or presentations, you'll actually find that over any long time period, this 50-50 combination gives almost comparable average return like a 65-70 kind of allocation, but it delivers the similar numbers but with much lower volatility. And now the taxation has also changed. If you have a fund which has between 35 and 65 in equity, you hold it for 3 years, it classifies as a long-term asset. At the end of 3 years, the tax will be 20% less indexation. And
Indexation.
that's the second area of surprise is people don't know that taxation works out more attractive. The tax outgo can be lower than the equity taxation also. So, three big things. One is that there were no balanced funds. We are creating it now. Second is a 50-50 combination gives you the best risk-adjusted return. And the third is that the tax outgo is actually lower than equity. So no reason why we should not be doing this.
So, Ashish, even after the three big reasons that you just mentioned now, why do you think there are so few 50-50 balanced hybrid funds in the Indian industry so far?
Because the regulation, so one is that all this taxation has changed. All the taxation anomalies have started to reduce only now. And people who have been managing a fund as 70% equity and 30% debt for so many years, now they suddenly, they have clients in it, they have corpus in it, they have a track record. Now they suddenly just can't change it. And the third thing is our regulation also is very clear that if you want to have a balanced fund, then you can either have an aggressive hybrid or a balanced hybrid. You cannot have both.
Right.
As a fund house, you have to make a choice because the regulator doesn't want you to proliferate products and confuse investors. So we have made the choice to make it 50-50 because taxation comes later, but the first fundamental basis of asset allocation is that if you have two asset classes, you should do 1/2 and you should keep rebalancing.
So talking about the market outlook, Ashish, considering the ever-changing market scenario, what's your view on the current situation and how does it connect with the fund strategy?
If you really ask me, well, yes, I do believe that this kind of fund structure, what we have created now, is relevant for the current market juncture. But to be honest, we cannot time the launch. Products are launched to be ongoing open-ended funds for times to come. But yes, it is. You can say it's quite opportune or quite a coincidence that in the current juncture, such a kind of fund would outperform or is expected to, at least in the next year or year and a half, is expected to do better than any other kind of asset. I'll tell you asset allocation. I'll tell you the reason. The reason is because we are finding ourselves in a scenario where our interest rates are at a significant high as compared to what we've seen in the last 1, 2, 3, 4 years. So if you take the 10-year government bond as a benchmark, it's been hovering around 730, 740, and threatening to go 750 and higher. And as you know, this is partly driven by the US raising interest rates. If you see, US interest rates are at historic highs, and typically, if US interest rates are at historic highs, then we cannot be reducing or lowering rates because that would cause turbulence for our currency markets. So partly the normalization after COVID, and partly because of US interest rates, we are finding that our own interest rates are close to peak. Now, what I'm expecting is that in the next 6, 12 months or 18 months, let us say the US, at some point in time, their economy starts to slow down. And if they were to stop raising rates, at some point in time, the US interest rate would peak out and the US dollar would peak out. That, I think, would actually drive interest rates lower in our markets also. And in fact, it's not just me saying. If you see in March, there was a belief that US economy is going to slow down. A couple of financial institutions went under, and 10-year bond in India actually went down to about 695 kind of level, well below 7. Correct. So after that, it has reversed because interest rates didn't actually decline in the US. So that's just, I'm giving you that as an example, that if there is anything which is a let up in the US, then we will see bonds rallying in India. And I think next 12 to 18 months, there is a good chance for appreciation on fixed income. And as you know, half the fund will be fixed income.
50%.
So I think there is good scope for appreciation in fixed income. Now, on the other hand, if you see equity, equity, we are at a situation where because of our domestic conditions and good economic performance, the markets have witnessed some buoyancy. On the other hand, there is a threat to markets that, from time to time in the next 6 to 9 months, there could be correction for 3 reasons. One, again, associated with US. Because if US economy were to slow down and consequently US dollar would depreciate, and if US interest rates were to go down, initially, it would be accompanied with some correction in equity markets like the one which you saw in March, right? So I think in the equity markets, what is happening is that we have been held up because of domestic flows and good domestic economic conditions. But there is a threat to our markets that whenever the US slows down, we would witness some correction comparable with what we saw in March. Second is obviously the geopolitics is getting complicated because now we have 2 wars instead of 1. Right. And the second one is threatening to flare up oil prices and spread into the Middle Eastern region. And the third is, of course, we have the run-up to our own general elections, and the market is priced for continuity. But before that, we have state elections and stuff. And, volatility cannot be ruled out. So what happens is, balance fund where we are trying to put 50-50 debt and equity. I think, both the asset classes, if fixed income has already corrected, we are entering at very high levels of interest rates. It has potential for good returns going forward. And because we are putting only half the money in equity, what will happen is if equity markets were to correct or depreciate, money will automatically switch from debt to equity. So I think half and half is a great combination, not only for long term, but currently also where we find the market to be. I think it's a great option. And last thing I'll tell you that, in March, taxation in India changed and it was quite negative for fixed income because now fixed income investments is fully taxable. So in such a fund, what happens is that because you're putting half the money in equity, because of that half equity, the other half of fixed income also gets a concessional tax rate. So if you really ask me from every perspective, We didn't time it really, but from every perspective, this kind of product category is ideal in the current market
in
circumstances.
this scenario? Right. And talking about performance and returns, what can investors expect in terms of performance and returns from this fund?
See, you should, I'll tell you there is a way to construct it. One is that, if you say half the money is in fixed income, and I would put it this way that, if you take 10-year benchmark, then, 10-year benchmark is say 7.5. We're not going to buy 10-year benchmark. We'll buy 3-year to 5-year AAA, AA plus public sector bonds, those kinds of things. So let us say we still end up getting close to where the 10-year benchmark is. Yeah, because there'll be some spread and stuff. And if you look at equity, 30 years index return is some 12% compounded. So generally speaking, how people do it is that, you would construct the return in three parts. One is what is the return you expect on half the portfolio, which is fixed income. What is the return you expect on half the portfolio, which is equity? And the third, which is very unique to such kind of products, is because you are going to consistently rebalance the debt and equity. That volatility and the inherent trade which happens in the portfolio, that if equity falls, then you're going to move money from debt to equity. And if equity appreciates, you're going to move money from equity back to debt. So normally when you hold on to equity and just keep buy and hold in equity or debt in any one asset class, if you do buy and hold, then you get the long-term return of that asset class. But you don't benefit from the profit booking or lower entry, because in this kind of product, you're automatically buy low, sell high. Every time equity corrects, you'll have to buy more. And every time it touches 60%, you'll have to automatically sell. So you get the inherent return of the asset classes plus the return which gets generated by this buy low, sell high kind of rebalancing which happens. So I would put it this way that, one should expect in a very tax efficient manner with low volatility, one should expect returns which are in the vicinity of, high single digit, low double digit kind of, now this is just a estimate, guesstimate I'm making, that we are not supposed to, you're not supposed to set up expectations in terms of how returns play out. But I'm just sharing this based on my observations and my experience. And obviously, you will find our presentation. It has all these simulations of how things have played out in the past. So I think I've given you educated guess.
So for these kind of funds, Ashish, usually is there a lot of interest from the HNI or ultra HNI or from retail clients or people who are just starting to get into the market? So who's the best fit for WhiteOak Capital Balanced Hybrid Fund? And what kind of financial goals can they reach through investing in this fund?
See, anybody who's looking to invest for more than 3 years, because now, not only taxation, but any which way short-term goals, mutual funds have variable returns, so not very amenable to short-term goals. So if you say anybody who has more than 3 years kind of time horizon, that is one. And it's relevant for two or three. See, one is people who, like, for example, you asked me a very pertinent question that where is the market now? How does this fit in? So people today who are looking to enter the market, who are looking to enter into equities, who are looking to enter into mutual funds, but they are confused about the scenario. So I think they'll be best served if they start with this kind of product, right? That is one segment. Second is there are many people who have been in aggressive hybrid funds or, aggressive equity funds for longish periods of time. But they realize that, okay, maybe 50-50 is a better combination, better risk adjusted return. And now the taxation is also not, no more adverse. Third is there are people who are doing debt allocation and equity allocation separately. But now they realize that if I do my debt allocation separately, then I'm going to be really hurt on the taxation. However long you hold your debt fund, you are going to get taxed at your marginal rate of taxation. Whereas if you go through a hybrid, if you take your debt allocation through a hybrid fund, then you are going to have much significant benefit on the taxation. And also, obviously, like I said, anybody who is a conservative investor wants to invest in equity, but wants to be conservative. I think for all of these classes of investors, this is an ideal kind of product.
Right. Since you mentioned that there are a lot of investors who are considering maybe to switch from an aggressive hybrid fund to a 50-50 balanced hybrid fund, what kind of advice would you like to give specifically to those investors? Full amount they should switch, or maybe do an STP way?
No, I think just switching straight away will be logical because they're already in the asset class. But what you will find is that aggressive hybrid funds, for the amount of volatility you are exposed to, if you were to take a ratio, like say return divided by risk, that what is the return I have got on an average on a 1-year basis. If I take in, let's say I've been in a fund for last 10 years. On an average in the last 10 years, what's the annual return I got? and how much was the annual fluctuation or volatility I was exposed to. So if you take return divided by risk, you will find that aggressive hybrid funds, they don't compensate you enough by way of returns for the risk or volatility that they expose you to. So ideally, they should be in a 50-50 fund because, see, if they wanted that volatility or risk taking and that maximization of return, then they should have anyway gone straight away to equity. But the fact that you came to a hybrid fund, arithmetic suggests that if you're in aggressive hybrid, you are not being compensated by way of returns for the amount of return or volatility that you are tolerating. So they should just straight away switch. I think it would be, ideal for them. Only thing to keep in mind is that here the taxation works in a way that at the end of 3 years, it qualifies as a long-term asset. So you must keep that time horizon in mind.
Before that, it is as per the tax law.
Exactly. Yes. So it's a must to stay for 3 years.
Right. Thank you so much, Ashish. I really believe that this video will help our investors better understand the benefits of a 50-50 balanced hybrid fund and help them make an informed decision. Thank you so much, Ashish, for your time.
Thank you very much.